welcome back. You're watching Crystal Ball, the special 2016 edition. I have been in conversation with Neem Kumar of IIFL. What do you hear when you talk to people, Neem? You speak to so many fund managers across the world who are India investors. I know we've seen FI selling over the last 6 months or so. How much of that recalibration is done? How much of the process of unwinding from emerging markets, including India, has happened already? And do you think we could still experience a lot of pain just from the technical aspect of money being withdrawn or continuously withdrawn from emerging markets, including ours?
Actually, then we have not yet seen big redemptions in EM funds to the extent to which we saw in 2008. You know, that scale of redemptions, if we see, and you know, particularly in the context of the fact that ETFs now have a much larger share of EM flows, as well as, you know, their ownership in India is much higher than what it was in 2007, 2008, right? So it was zilch, near zero at that point in time. So if redemptions happen, there definitely would be a sell-off. If I look at the other EM funds and the global funds, today what has happened is that most funds, you know, they have concentrated their India holdings in few stocks. 20 stocks account for almost 80% of all FII holdings, and the fund managers are very happy owning these names. A is that this basket has done well relative to the other emerging market portfolio over the next 12 months. Especially in dollar terms, given the strength that we have seen in the rupee, relative strength that we have seen in the rupee vis-a-vis the other currencies. And secondly, there's not much of choice left this one. So they don't want to take risks which they normally would have taken when they come to India to buy. They are happy with even low growth, but they want visibility in terms of earnings, and they are willing to pay up. As we speak, I think most EM funds are overweight India. Non-ETF funds are overweight India. And in case these funds see redemptions, then there is always a risk that India will not be spared. So we'll have to keep that in mind. This is something again which none of us can predict.
This phenomenon of holding 20 stocks and try to not spread your risk, has it worked against sectors like private banking, pharmaceuticals, you think, Neem? Because these were the leaders of the last big run. And the way some of these private banking names or the frontline pharmaceutical stocks have come off, it leads you to think that maybe there is an ownership problem out there which is just unraveling.
In a few cases, yes. But it's not true across the board. So, if you look at those top 20 names, you would have Infosys, TCS, you would have names like HDFC Bank, Kotak Bank, and you will also have names like L&T and ICICI and Axis. So it's been a mixed trend. If there were large redemptions in the EM funds which are overweight India, at some point in time they'll have to sell across the board. But at this point in time, that doesn't seem to be the case. They're still, trying to maneuver their portfolio, trying to reduce risk, because even within a sector, what is happening is that the risk is so different from stock to stock. Like, for example, a large basket of PSU banks have become really uninvestable for long-term investors simply because of the fact that their ROEs have collapsed, growth is not there, earnings visibility is poor. So therefore, they have shifted away. So again, it becomes relative, right? If you want to allocate X amount of capital within the top 40 stocks, what do you do? So which effectively brings down to this small list. But the risk of, they selling some of these names, if they don't do well, of course, that is a big risk. And that's why we are seeing large volatility in some of these names. So if you look at the, volatility in some of these 20 stocks, it's been pretty high simply because of this reason.
You mentioned 3 names out there, L&T, ICICI and Axis. Do you think valuations could contract even further in some of these names after the kind of fall that they've witnessed already?
See, I think without going into individual names, my read is that, there is going to be pain in all cyclical sectors, including banks. The concept of the stocks being cheap and therefore one should be looking to buy doesn't work in an environment where risk is expanding. So this is not a normal, this is not a sane environment, and therefore, it's like trying to buy a commodity company which has large leverage. The risks are very high. I mean, if you want to play that, you have to just buy a commodity company with very low debt, so that you don't have, you are not pushed to price in risks which, today you can't quantify. So therefore, my read is that, all cyclical sectors, including banks, they are in for a period of pain, and we'll have to keep this in mind when you look at some of these names.
You started this discussion by talking about the elusive earnings recovery. For the last 2 years, I've been hearing a lot of analysts talk about how it's just a matter of a couple of quarters and then earnings will start picking up. Now it's come to that extent where people are saying, how long can it not pick up? Because we've had almost 4 years of pain. The bend must be, or the turn must be around the corner because we've been down in the dumps for so long. That doesn't seem like great analysis to me. Is there any data point or metric which is telling you now that other than the base effect, there's anything which will lead to a fairly significant uptick in, say, volume growth or revenue momentum in the companies, which will make Indian companies relook and reconsider capex once again?
See, the thing is that, Udayan, today you look at the capacity utilization. In India, after 4 years of, call it 6% plus growth, capacity utilization has actually come down. And we have created so much of capacities today that a lot more demand pickup is needed for pricing power to come back. The global backdrop is very challenging. Today, if you're a steel producer or an aluminum producer, I mean, what do? You have to compete with the guys in China and guys in Russia, right? So, this whole concept of earnings bottoming out, even 12 months ago, what you said was what being talked about. We ourselves have run chart books with margins having come off very sharply, and that margin should pick up. I remember an analysis that we had done in 2003 based on an RBI report as to how much gross margins have shrunk and how much it could potentially expand. But in the last phases of correction, the margins had fallen much more. Maybe it doesn't fall as much because your input prices have come down. In some industries like FMCG are seeing margin expansion. But I am more worried about sectors like banking because, the non-performing assets. You could see an acceleration. Therefore, my read, and if you look at many of these sectors where return on equity has so sharply collapsed, take telecom as a classic example, large sector, and returns used to be over 25% in 2006, 2007. Maybe, companies have made overseas acquisitions, maybe they have paid a lot for spectrum, ROEs have come off, earnings visibility is poor, and therefore, the issue is that you disaggregate this across sectors and then see where, what can drive a turnaround in growth. I am not able to get that comfort as of now. So therefore, I think you would continue to see more earnings downgrades. The current estimates of 15% earnings CAGR between FY16 to FY18, to my mind, is unrealistic. We have seen this happen in the past. People start off with very high numbers and then they are pushed to downgrade, and downgrades happen not in small steps. You're forced to downgrade earnings by 30-40%. Look at all the large caps, and despite the fact that these cuts have happened, is there a improvement in visibility for them to turn around? In many sectors, the answer is no.
How would mid-caps typically perform in this kind of an environment, because that's where a lot of hope has crept in. Mid-caps have outperformed. Do you think it might still be a market where select stocks might be rewarded for reasonable performance? Or is this a kind of an environment which is generally more unkind to mid-caps than large caps?
In fact, a combination of factors, including flows into domestic mutual funds, into mid-cap schemes, the fact that a number of large cap sectors have become uninvestable, and therefore people are looking for growth stories in quality mid caps, and therefore, you know, quality mid caps trading at a premium to several of their large cap, not only just peers but many large cap stocks. Will to my mind continue. You know, there are like at least 5 or 6 large cap sectors which many investors tell me have literally become uninvestable, or they, you know, they are just trading buy. So if the stock falls very sharply, they try to buy and they try to make 10% or so. But you know, large investors in US, and when they come in, they want to own names for 4 or 5 years. And in fact, these guys, I'll tell you, they are much more, they are very happy to look at names, even smaller names, where, you know, management quality is good, earnings visibility is higher, and the capital efficiencies are good. So I think this trend may continue for some time. It's whether you are a large cap or whether the stock is a large cap or a mid cap may not matter as much as the quality and visibility of earnings and you know, the quality of management as well.
Thank you very much for your time, Name. Always a pleasure. Thank you.
Thanks, Udayan. Cheers. Bye.